Hi everyone and welcome to today's video. In my last investing video, I told you how to get started with investing, how to know when you're ready, which account to use and how to get set up. In this video, we're taking the next step, so I'm going to show you how to build a beginner-friendly investing portfolio. Before we get into it, please take a second to give the video a like. Thank you for the like. And if you want to see more videos in my investing series and many more videos to come, then just subscribe below to subscribe to the channel now. This video will show you how to build a beginner-friendly investment portfolio, one that's simple, diversified, low stress, and designed for long-term growth. No jargon, no stock picking, and no trying to outsmart the market. This is general information, not financial advice, but it will show you how you can build your portfolio. Also, if you're brand new, be sure to watch the first video in the series as well. So first, let's get into what is a portfolio. So your investment portfolio is simply the collection of investments that you own. That could be one fund, it could be a mixture of funds, and these will be held in your stocks and shares ISA. A good beginner portfolio has 3 goals. Diversification, so you're not relying on one company or country. Simplicity, so you actually stick with it. And long-term growth, not short-term wins. The biggest mistake that beginners make is that they overcomplicate this. You don't need lots of investments to be well diversified. It can be really simple. Let's get started with the first step. Step 1 is to understand your risk. Before choosing any investment, it's important to understand your risk. In investing, risk doesn't usually mean losing all of your money. It mostly means how the value of your investments can go up and down along the way. So very roughly, lower risk investments usually move less, but they grow more slowly. Higher risk investments move around more, but they tend to offer higher long-term growth. One thing that often gets misunderstood is index funds. Index funds are lower risk than picking individual stocks because your money is spread across hundreds or thousands of companies. But they're still not low risk in the everyday sense because they can go up or down. Truly low risk investments are things like cash or bonds. These tend to be more stable, but they usually grow much more slowly over time. And something that's worth remembering about cash that I always like to point out, and the problem with just saving rather than saving and investing, the real long-term risk is loss of value over time due to inflation. Even if the balance doesn't go down, its spending power can. That's why for long-term goals, investors do need to be comfortable with some level of risk. So now that that's all out of the way, let me help you understand your own risk tolerance. Ask yourself, how would I feel if my investments dropped by 20 or 30% in a bad year? Would I panic and want to sell, or would I be able to stay invested and wait it out? Am I investing for a short-term goal, or am I investing for something that's 10 to 30 years away? At the end of the day, you only lock in your losses when you sell, so if you can stay in the market and ride it out, then that's usually best. Because the market has historically always trended up. For context, what I normally do is I keep my long-term investments in index funds. I'm investing for decades, so short-term market dips don't tend to worry me too much. I think something that helps me with that is not checking my portfolio too much, so I don't check on it every day to see what's gone up or down, and I think that's quite helpful for me. That won't be right for everyone, but that's just what helps me stay consistent. If you're investing for the long term too, so 20 to 30 years, being 100% in equities can be completely reasonable, as long as you understand that things can go up and down along the way. There's no correct risk level, it's whatever works for you, whatever will help you stay invested. Let's move on to step 2, which is the core of a beginner portfolio. For most beginners, the core of their portfolio is index funds. Index funds track hundreds or thousands of companies, they're low cost, they are automatically diversified, and they've historically performed well long term. And the reality is you don't need many of them. Option A is the simplest portfolio, it's just a one fund solution. This is the true set it and forget it option. A single global stock market index fund gives you access to the US market, the UK market, Europe, emerging markets, and thousands of companies. For many beginners, this alone is enough. You just buy into one fund, you have access to the world stock market, you add money regularly, you leave it alone, you set it and forget it. Simple doesn't mean bad, it's actually all you need. I'll put some examples of global stock market index funds on the screen so you can check those out. Option B is still a simple portfolio. This one has 2 to 3 funds. If you want a bit more control, then you might like to split things up. For example, if you have certain markets that you want to invest more into, or you want to invest less into certain markets, then you can do that yourself if you choose your own funds. You might want to choose different funds based on geography or sector, but if you want to keep it simple, then you might include the global stock market index fund that I just mentioned, and then you might like to have a bit more exposure to the UK market, for example, if that's your goal. So you could invest in a UK index fund, or you could put your money somewhere else if you want a bit more exposure elsewhere. If you want to reduce volatility, then you might invest into a bond fund. This is optional though, as same with the UK fund, this is completely optional, just if you want to have a bit more control. You don't need to overthink the percentages at the start. Consistency matters far more than precision, and what you actually just want to do is make sure you're investing. That's why I usually recommend a global index fund for beginners. Step 3 is a little bit more info on bonds, balance, and some simple rules. Bonds are often added to a portfolio to reduce volatility, so the extent and speed to which the value goes up or down. They tend to move around less than shares and smooth out market swings, but they grow very slowly over time. If you're younger, you're investing for the long term, and you're comfortable with some market drops, then you might want to start with 100% equities, and then you can add bonds later if you want to. If you prefer a smoother ride, then adding bonds could help. If you like a simple rule, then one commonly used guideline is 120 minus your age. The number you get gives you a rough idea of how much you could hold in shares, and then the rest would be in bonds. For example, if you're age 30, then that would suggest that you should have 90% shares. At 40, it would be around 80% shares. This isn't something you have to follow exactly, it's just to give you an idea of how time horizon and risk work together. Most beginners these days choose to start with mostly or entirely equities, and then they can adjust this as their confidence grows. Step 4 is how much to invest in each. This is where people often get stuck, so let me reassure you, you don't need the perfect allocation. What matters most is obviously starting, contributing regularly, and staying invested. Just choose a simple portfolio and stick with it. You can always adjust later as your income, your confidence, your goals change. Doing something beats waiting for perfection. Step 5 is market reality. This is completely normal. Even the best portfolios will go down sometimes. Feel uncomfortable at times, test your patience. Market dips are normal, crashes happen as we've seen. Recoveries happen too as we've seen. The biggest risk to your portfolio isn't going to be market drops, it's actually you panic selling. Because like I said earlier, you only lock in your losses when you sell. Also, there's been lots of studies on if you miss certain days in the market, then you lose the chance for most of the growth that you can get in the market. A beginner-friendly portfolio is designed to help you stay calm and stay invested so that time can do the heavy lifting. So that's how to build a beginner-friendly investment portfolio that's simple, diversified, aligned with your risk level, and designed for long-term growth. You don't need to be an expert, you don't need perfect timing, you just need a plan you can stick to. A quick note before we wrap up, a lot of you have asked for more personalised help than I can give you in the comments. I've started offering 2 options, one where you can submit a longer question and I answer properly. This could be about investing, budgeting, saving, whatever money topic you want to ask about. The other option is where we can talk things through on a call. It's education and guidance, it's not financial advice. I'll leave the link in the description if you're interested. In the next videos in the series, I'm going to cover index funds explained, the top investing platforms, and my top picks for index funds. I'm also planning more investing videos, so leave a comment if you have any requests. Also, let me know in the comments where you're at with investing if you're just starting. I'd love to hear where you are. Thanks for watching, and I'll see you in the next one.